the Finance Solver. So it's all Finance Solver basically for this last one really. And let's just read it through and try and identify the key parts of the question. Okay, Brian decides to purchase a new car with a price of $14,000. So that looks like the cost. He cannot afford the full amount. And there's two options to finance a loan. A 6-year loan. Okay, so you're going to borrow $14,000 now. 6-year loan. Annual interest rate of 14%, compounded quarterly. No deposit required. And repayments are made each quarter. Find the repayment made each quarter. Okay, so this looks super complicated. Okay, so it is straight to Finance Solver. So we're going to just go straight to the calculator and see what numbers we need to substitute into Finance Solver. Okay, so menu, Finance Solver. Okay, so we're just going to write down here. Okay, so N is the number of payments. Now let's just think about the number of payments. It is, get this pen out here. Okay, so there is 6 years, and there is 4 payments per year, so that's 24 repayments. Okay, so that's equal to N. The interest rate, well, the interest rate just tells you straight away in the question, isn't it? 14%, just 14. It's compounded quarterly. So that is the that's kind of like PPY/CPY, 4 payments per year. The present value, okay, the present value is the money that you're going to receive from the company, the finance company, which is 14,000. And the final value has to be 0 because you've basically paid it all back. Okay, so let's see if we've got everything that we need to feed in here. So N, the number of payments is 24, 6 years at 4 payments per year. The interest rate is 14. The present value is 14,000. The final value is 0, that's right. And then this PPY, payments per year, is 4. And that compounding periods per year will actually always, for us, in these questions, it will always match the PPY, okay? It is possible for these to be different, but I think the questions on our course, they'll always be the same, which will be quite helpful, I think. And we can then click on payment here and press enter. Oh, try again, press enter. And can you see minus 871? So when we solve for that, we get minus 871.82 because that's the money flowing away from us. So that's how much we have to pay out each month to actually be able to take out this loan. So there's the first one. So that, you know, as long as you know how to use a Finance Solver and put the numbers in the right place, then it's essentially an easy 3 marks. Okay. Find the total amount paid for the car. Well, look, you're taking out a loan of 14,000, but you're paying interest on it. So obviously, you're going to pay more than 14,000 for the car. Now, if you just think logically about it, this is the amount you pay each month. Okay, and then we already have 24 months. Not 24 months, but oh, that's actually wrong, isn't it? It's not the amount we pay each month. And let's read it again. This is for each quarter. Okay, so let's just adjust that. This is 871 each quarter year. Okay, and you're repaying 24 quarter years. Okay, so it's 24 times by 871. 871.82. Now what you can do is you can actually just on your calculator you can take this and you can just press escape and then paste it into here. We can get rid of the negative now. That's just to indicate that we are paying it back, and we just times by 24 and out comes 20,923.67. Is it, what's the cost? Is it dollars is here? Oh, it's euros. Okay, so let's have a look at the next part. Find the interest paid on the loan. Okay, so the interest is basically how much extra you've had to pay. So if we take this value here, I just copy that over. I just paste that into here. So that's how much we pay in total, but the actual loan amount was 14,000 officially. So you can see that, wow, we've paid 6,923.67 just in interest. So you can see that 14% is a pretty high interest rate, and this talks about the amount of interest, not the interest rate for 14%. It's the amount of interest. So it's a physical quantity, and there it is. Okay, so finance option B. So this is different now. So we still need 14,000 to pay for the car, but we are being offered a 6-year loan, R% compounded monthly. Okay, so I think Finance Solver coming out at some stage. We require 10% deposit and then monthly repayments of $250. Find the amount of the loan to be borrowed. So again, this seems super complicated, but basically 14,000 is the cost of the car. Okay, and this finance option is going to give us not quite 14,000, but it's going to give us 14,000 less 10%. So we have to actually physically put some cash towards this car for ourselves. This is a common finance scheme. The company won't lend you money unless they know that you've got a little bit of money of your own to commit to it. So if you commit 10% of your own cash towards this, finance companies tend to think you're a better deal in terms of, you know, being able to repay the full amount that they loan to you. So basically, I'm going to have to pay 1,400 as a deposit, and then I'm going to borrow the rest. So I'm going to borrow 12,600. Okay, so this is the amount of loan to be borrowed. Okay, and now the next part is find the annual interest rate. Okay, so I need to present value. I need to borrow 12,600. Yep. R is what I'm trying to find. N is the total amount of payments. Now we need to, this is where I have to do a little bit of work. 6 years, and I am going to have monthly repayments. So 6 years, monthly repayments. 6 times 12 is 72. I'm going to make 72 monthly payments, 72 repayments, okay? And the amount I'm going to pay each month is fixed. The amount I'm going to pay each month is 250. 250. And I think that's just about it, isn't it? The interest rate is compounded per year, monthly, and then that's going to match the payments per year because I'm paying monthly as well. Okay, so with all of that data, then we're just going to switch to our menu, Finance Solver again, and off we go. N is now 72. The interest rate is what I want to find, so I can just delete that. The present value now is not the 14,000, I want it to be 12,600. The payment, now remember payment is going away from me, so I've got to pay minus 250. The final value is 0 because I want to pay everything back. And now instead of quarterly down here, I've got monthly, so 12 here, and this automatically updates to 12, okay? So let's have a look. We're solving for interest rate, so click on here, press return, and the magic happens. So R equals to 12.56%. I suppose R equals 12.6% if you're rounding to 3 sig fig. Okay, so make sure you round to at least 3 sig fig or higher accuracy there. The only thing missing in my working out there was the final value was equal to 0 because we wanted to repay all the loan. Alright, and so let's go back to the question. State which option Brian should choose and justify the answer. Well, I suppose there's a number of things that we can think about here, can't we? That we want to know how much does this person repay. So scheme A, scheme B. On scheme A, we worked out, didn't we, that we actually had 6,923 was the interest that we paid, 6,923.67. Okay, so that's interest. We had no deposit to pay. Right, so we'll just compare the schemes. Here we had 1,400 deposit to pay. But if you think about the interest that we actually paid back, So let's try and work that out. Let's go back to this question. We made 72 payments of 250. Okay, 72 payments of 250. So let's try see how much we paid back. 72 times 250. So we paid actually 18,000, but we borrowed 12,600. So if we subtract 12,600, we see that the interest we paid was 5,400. Okay, so you've got to think about which scheme was better. And as long as you justify your answer, you can actually choose either scheme. So let's justify why scheme A is better. Scheme A is better because we didn't have to pay a deposit. So what if you don't have 1,400 lying around in your bank account or in your pocket? Then it's going to be hard to choose option B. Option A allows you to get straight in and buy that car because you don't need to put up any of your own cash. So that's why we might choose A and say it's a better option for Brian, okay? So we don't know Brian's financial situation. However, you might also say that, hold on a second, option B is a great option because look, the finance company is only getting 5,400 of your cash versus 6,923, okay? So there's less interest to pay with option B. So either of those two answers would be absolutely fine. And then finally, Brian's car depreciates at an annual rate of 25%. Okay, well, the car is priced at 14,000, and this is not even a finance solver needed for this. This is just a bit of common sense. If you reduce by 25%, you've only got 75% of it left. If you want to know how much it's worth after 6 years, you just power it up to 6. So this is kind of a simple calculation to finish with. I think the lesson for this question is that, yes, it's tough, it's Finance Solver, and we've kind of forgotten how to use Finance Solver. But if you go all the way through to G is not anything to do with Finance Solver. So you could have just picked up 3 marks on question G if you just read through to the end and be patient with yourself. So that's times by 0.75 to the exponent 6. And there we have it, 2491.70. And if you wanted to, that will be 2490 to 3 sig fig. This answer would be okay, as long as you have the full accuracy written down there. That would be fine, but this would also be fine.